Welcome everyone to Binary.com with our Forex Swing Strategy webinar on the 22nd of July 2014 starting at 7 p.m. UK time. My name is Chris and I'll be your host of tonight when we take a look at this strategy. Once again, hosted by Binary.com. Before we take an actual look at the charts and what we will be looking at, the main topic of tonight, this risk disclaimer explaining that trading for exchange, global financial markets and products is considered high risk and it may not be suitable for investors and certain traders. Please seek the advice of an independent financial advisor for more information on that, who could advise you better. And please be aware that this webinar is for educational and informational purposes only. All right, so by continuing watching this webinar, you agree with the disclaimer mentioned here and on the binary.com website. Excuse me. So as always, thank you so much for your attention. So last time we talked about intraday strategy, this time around a swing strategy. The difference clearly in the fact that intraday, it already says it is within the day. The swing is more commonly known for opening and closing a trade within a week or month. That can sometimes vary depending on from trader to trader. Trying to basically capitalize on volatile and liquid financial markets which make big or relatively big price movements. All right. So some traders like to keep a trade over the weekend, some do not. That I would say is maybe the difference between someone who trades within the week and within the month. So typically speaking, if you're looking at a 1 hour time frame, that could be a intra-week trader, a 2 hour maybe as well. A 4 hour is on the border because that could easily go over the weekend. All right, so there are two groups of swing traders basically, but we'll just consider now for the moment the 4 hour charts in this strategy. All right, so the advantages of swing trading, just before we dive into the strategy itself. No stress basically, or not, maybe not no stress, but less stress during the trading day itself, because obviously if you're trading intraday, you're keeping a very close watch and eye on what charts are doing and what price is moving. So if you're using swing strategies, obviously one 4 hour candle has less impact and influence on what is going on than if you're trading 50-minute charts, because you just have 16 candles of 50 minutes in a 4 hour candle. Whereas if you trade a 4 hour candle, obviously, if you, at the end of the working day, you only have 2 candles, 2 times 4 hours. So, doesn't mean that there's no stress at all, but if you have eventually enough experience, then you realize that nothing much usually happens in 1 or 2 candles. So there's not that much stress needed. If you're trading fast on lower time frames, it could usually cause more stress depending on how much experience someone has. It usually is easier to manage and to hunt for trades, right? So of course the managing depends how you're trading. If you're using options, the binary options, then that would not be so important. But if you're still hunting for entries, then that could be very important, right? How long does it take before you find a potential trade? That might require less intensive time, and also the chance that you miss a particular setup is still a bit less, because let's face it, you have an entire 4 hour bar to react. Bigger wins and higher reward potential sometimes, right? Bigger chances of a trade developing if you're using higher time frames. The reason for that is just because, if you use lower time frames, first of all, it's more difficult to react to those candles, those events, but also the information we see on a 4 hour chart and a daily, for instance, is a lot more valuable in the sense that if you look at the daily chart, that's the balance, the end balance of the daily chart, and at the end of the day, you had all the participants fighting within that day, let me say, and it's a bullish or bearish candle or a doji or a reversal candle, and that has a lot of meaning. That has more meaning than looking at a 1 minute chart, right? Because a 1 minute chart, well, it has its limitations. The disadvantage, market moves slower. No, sorry. If there's a slow market, that could be difficult because swing traders are looking for follow through. Well, that's always difficult if you have a slow market. That could happen on higher time frames. It could take long for a trade to develop. That could require patience. It's maybe disadvantage of overtrading. You know, if things take long to develop, one could be tempted to trade more than really necessary or wanted, and more exposure to the market because of the length of the trade. All right. Alrighty. So now I think we can start. Let me just quickly answer a question from Rakin. I'm not sure what Rakin you mean with participants, but I am the only host if that's what you mean. All right. Good. So let's take a look at the strategy. The tank and swing strategy, as I call it, is called the four horses. Now that's just, of course, a name. It really, to be honest, could be called anything, but that's the name I gave it. All right. So it's using certain tools and indicators. All right, let's take a look at that. Now, there is a reason why I do call it four horses, is because we're using four indicators. All right, so that was the idea. But um, the first thing that we're using is the Ichimoku indicator. All right, for those that do not know it, that is basically a Japanese, or invented by someone from Japan. So it's a Japanese invention, and it's a way of looking and understanding support or resistance, for instance, when looking at price. How many here know the Ichimoku indicator? Is it something that you know, or is it the first time you hear it? How familiar do you think you are with this particular tool? It's not difficult, but of course, it does require some understanding and some knowledge before you can trade it. Obviously, it even the simplest of tools, you still have to, of course, go through the understanding curve before you can actually use it. So once again, how many people have in here know the Ichimoku indicator? Just out of curiosity, let us know through the chat. What we're going to use, because the Ichimoku actually has various things, 5 elements on the charts, we're going to use 2 of those: the Tenkin and the Kiyun. All right, this might sound funny to you, or strange, because the names are maybe not familiar. So then, to me, it's, it's when I've heard it for the first time, I had to frown because what is this name actually? I never heard of it. I heard of moving averages, I heard of trend lines. They all made sense, but never heard of Tenkin or Kiyun. That was something totally different. So we only use 2 of those out of the 5. The rest I delete. Now, unfortunately, I forgot actually to put a screenshot of the entire indicator, but okay. But this is how the Kiyun and Tenkin looks like. The rest of the indicator basically has one more line in the past, basically plotted in the past, and it has a Kumo cloud. The Kumo cloud is kind of like a support and resistance, basically, where price is hovering or below price, and it's used as support and resistance. Now, the Kiyun is the blue line in my case here. It's a bit slower. The Tenkin is a bit faster. What it does is it takes the open and the high and the low of a fixed period in the past and divides it by an average number of bars, right? What it does with the Tenkin, I think, is 9, if I remember correctly by heart, and the Kiyun is 26. So that's why the Kiyun will respond slower, because it's, in a way, it's similar to a moving average. Like the EMA, for instance, has a level of 26, and sorry, I said 26. Excuse me. I mean, the EMA could have anything, of course. It could be 40, it could be 50. But if you put a EMA that's lower, has a lower value, so let's say we choose a 50 and choose a 20, the 20 will react faster to price, right? So that's the same for the Tenkin and Kiyun. The Tenkin is faster. The Tenkin is the fast one. It reacts fast. The Kiyun is the slower one. So if you need, write it down if you need it to remember that. It's just something that has to either be written down or remembered, right? There's no logic to it in the sense that I can't find any logic in the sense that Tenkan is faster. That's of course the advantage of the EMA 20. It's logical. 20 is faster than 50, right? That logic is not here, but just write it down and soon enough you'll know that. So Tenkan is the faster one. Now, what it does is looks at that period in Tenkan 9 periods, and it takes the high and the low. All right, it takes high and low. Now, the difference with these compared to the EMA is that the EMA takes every single bar into account and looks at the close most of the time. Most of the time, we look at the EMA close. It looks at, if you want to, high and low sometimes, but most of the time, the close. Now, it would do that for every bar. This is different because this is looking at the last 9 and looking at the highest and lowest of those 9, or 26, and then plotting the average there. So it's a bit different how it's calculated. And it's chosen these numbers because of the Japanese stock market, actually. That's where it's actually geared towards, and that's why it was developed for utilizing on that particular instrument. Now, the concept has been used also for Forex and has also been actually introduced into to Europe and other parts, US and other parts of the world, not so long ago. Basically because this technique has been, I think, around for very, very long, but relatively new in other parts outside of Japan. Now, what it does, basically, the idea behind the Tenkan and Kiyun is, in my opinion, momentum. We can read momentum from it because the high and the low indicate kind of the range environment. So if the high and the low stay the same, the Tenkan and Kiyun will go flat. All right? If the high and the low are the same within 9 or 26 bars, right? So if we have one bar, let's say one bar that's on the right here, right? If that bar has the same high and low as the one to the left, the Kiyun will be flat. And you see, when you look at this Kiyun, you see substantial parts, the blue line, that are flat. That's because the high and the low at that point didn't change. So what does that mean if the high and the low are not changing? That means there's consolidation. That means that the price is not moving out of a certain zone. That's what I mean with momentum. I hope I'm not confusing you, but it's always, I have to take various traders here into account from experienced and less experienced. But if it's flat, there's less momentum, basically. And if it's an angle, there's more momentum. And that's everything to do with the fact that the high and the low are shifting. If the high and the low are shifting, what is happening? There's a trend. What is the classical definition of a trend? Higher highs, higher lows. For an uptrend, lower lows, lower highs. For a downtrend. So if the highs and lows are breaking, we're in a trend. So that's what the Tenkan is showing, and the Kiyun. But if we're not breaking the high and lows, we're not in a trend. And then they go flat. You'll see that the Tenkan has less parts that are flat because the chances of a high or low breaking in a short period like that is higher than with the Kiyun. The Kiyun has more often that the Kiyun is flat. And you can see that here. It has pretty substantial parts that flat. Now the EMA doesn't have that. The EMA will always have, most of the time it has some angle. It will have to be really coincidental if it's mathematically exactly level. It might visually look level, that's true, but not entirely. Although visually it could be very close. But that's also a bit of the disadvantage of the EMA is that what type of angle do you have with the EMA? It's difficult to read. The Tenkan and Kiyun is a lot clearer what angle it has and if it has an angle. That is the advantage of these two. The other tool is the parabolic. Now this is probably a bit more familiar. I use values 2 and 5. Let's take a look how that looks like. This is how the parabolic looks like. It's a method of, it's been developed by Wilders, and it is a method to basically gauge when price is ending a momentum again. When price starts to basically push into one direction, let's say here on the left, it's an uptrend, all right? But that uptrend is going to stop. So when the price starts to speed away from these dots, right? The dots will start to increasingly go behind the price. It starts to accelerate closer and closer. You can see the distance between these dots, the gaps here as price moves further are increasing until eventually price makes a correction and hits one of those dots. Then the dot goes back to the opposite side. It was on the bottom, it goes back to the top, and the dots then start to descend slowly. But if price starts to move down, indeed, the dots will start to descend faster and faster until price hits it again. So basically, it's a good way of measuring when a trend could end. It's a good way of a trailing stop, for instance, if you use that. And it's a way to have a measurement of price and time and try to catch a momentum move. Why the dots accelerate and what pace, it really is not too important. Just note that they accelerate as price moves into that direction. Also note that you can use different values that hover closer or less close to price. Those green dots are further from price than the pink dots there. All right, so the pink dots will cross to the opposite side quicker than the green dots. And otherwise, it's just an interesting method for identifying breakouts, basically. That's what happens. All right. Instead of using a trend line, you can use these dots to have an idea when the trend is changing. All right. So let's take those concepts, let's take those tools and indicators and put it into action. Using these 5 steps: defining the trend, searching for opportunity, checking for filters, establishing the trigger, and then deciding the entry method. What is the trend? The trend, interesting enough, there's almost always a trend according to the definition of this strategy. In some rare cases, if the Tenkin and Kiyun are exactly equal to each other, then there would not be a trend. But most of the time, one of the two has a higher value, so we would either have a down or uptrend. That's interesting because most strategies of mine also account for a zone of, let's say, neutral, right? Not down or up. So that is the trend. Tenkin above the Kiyun, Kiyun below the Tenkin. Let's take a look at a chart here. So when the Tenkin is red, all right? Tenkin is fast, that's why I made it red. If the Tenkin is above it, it's an uptrend. If the Tenkin is below the blue, I should say, the Kiyun, it's in a downtrend. It's really that straightforward regarding the trend for this strategy. There is one spot, I think, on this chart I see, yes, that the Tenkin and Kiyun are equal to each other. And that's exactly this part where I'm putting my cursor on the left, right there. You see that the red has actually disappeared. It's because it's under the blue. That's where there's no trend involved. By coincidence, we have that here. Otherwise, as soon as one is higher than the other, we have a trend, right? If the red is above blue, we have an uptrend. If the red is below the blue, we have a downtrend. Once again, no logic in the sense that why Tenkin is red. I just chose it. It's just something that one has to write down, and that's it. I mean, the Tenkin is just and the Kiyun is just a trend for this strategy. Now, there is a bit of logic in the sense that obviously we're looking. There is logic. There's no other way to memorize it necessarily. Just better to write it down. But the logic is that if the faster one is below the slower one, then obviously price is dragging down, is going to the downside. If price is above, is dragging the faster one above the slower one, it's moving to the upside. Just like an EMA. Here you have, with the first example here, you have price not making a lot of trends, right? It's just, well, there's some movement, but not a very big trend. This is a better trend. Here you see a fluid move down, very nice lower lows, lower highs, and this is where in the middle part there you see the Tenkin, the red one below the Q and the blue one making that downside trend. So that would be a good example of a trend. The first one was so-so. But it doesn't matter as long as, for the moment, the Tenkin and the Q are the trends. That's what we have to know. Let's move over to step 2, the opportunity. All right, that's the angle of the Tenkin. We already talked about the angle of Tenkin and Kyun, but now the opportunity. The only thing that's important is the angle of the Tenkin, not the Q and the blue one. Only the red one is important here. Why is the angle important? What is the logic behind that? It has to do with the fact that there's momentum. Because if the Tenkin is flat, then price is not making higher highs and higher lows, or lower lows and lower highs within those 9 candles, which means that we're in a consolidation. And that is not the environment that I would, that the strategy is looking for. We want to see momentum. So let's take a look at this chart. This is the Euro odd 4-hour chart. And you can see that price, when it was, the Tenkin is below, the red is below the blue here. All right. The Tenkin, most of the part, look at that, has a downside angle. It doesn't have to be a very strong downside angle. It could be mild, as long as it's not flat. But it has to be down in a downtrend. It has to be aligned with the trend. So when I say an angle of a Tenkin, in a downtrend, the angle has to be down. In an uptrend, the angle has to be up. They have to be aligned. If we have an up angle in a downtrend, it's the opposite. If we have a down angle in an uptrend, it's the opposite. That's not good. What I'm looking for is a downtrend and a down angle on the Tenkin. I'm looking for an uptrend and an up angle on the Tenkin. So when we look at this chart again, all this is fine where I'm having my cursor in the middle, because the Tenkin, the red one, is angled down and below the blue one. Right? The upside, Tenkin is angled up and above the blue one. That's good. Let's take a look at some example maybe where they're not aligned. If I can find it. Let's see. Here, right here. The Tenkin is above the blue one, but is pointed down at this spot, just like here, and here, and here, right? Those then do not qualify. And if they don't qualify, well then, there's nothing to do on that particular chart. Here too, despite the good downside, not all spots will qualify. Here we have up angle but downtrend, up angle, downtrend, flat but downtrend. That's not good. The rest, of course, down angle, downtrend, good. Uptrend, down angle, not good. Does not qualify. So I hope that's clear. If you have questions, let me know. Otherwise, I'm assuming everything is good to go regarding the trend and opportunity. And we can move on. So now that we have the basic structure of what we're looking for, which is, I think, relatively straightforward, but it all depends, of course, how you're familiar with maybe the Tenkin and Kyun. But now I'm going to add one more layer of analysis to it, and that's looking at filters. Filters basically means filtering out trades that are not likely to succeed, less likely maybe than other qualified setups. We talked about filters. I talked about filters at binary.com not so long ago, I believe. I'm not exactly sure what the date was. Maybe you want to check that out. So the process of filtering out is looking at a particular setup and saying something here doesn't add up. So that could be discretionary. That could be a very straightforward process that you always look at the same thing. this is something that I did not necessarily, this is something that depends from trader to trader. When I when I'm looking at my testing results, basically I didn't incorporate the process of filters. So this is something that could only hopefully improve the trading results that I at least achieved, right? So those are news events, for instance, are just suggestions that one could think of. News events, not necessarily necessary because it is a 4-hour chart. We are talking about a swing strategy. Still, if it's a very big one, like an NFP or an interest rate, one could still think of doing that. Daily tops and bottoms, for instance, or weekly tops and bottoms. Those are heavy support and resistance levels that could stop price from continuing. Daily, weekly pivot points, divergence are all concepts that one might want to think about when tackling the market. All right. How would that look like? Well, here's an example. Here on the right side, you see price fell a lot, made an upside, and then at the very right corner of the chart, you see price stopping at the previous bottom. Well, that is an example of a daily support level, and you can see price didn't break through that support level. In the Forex market, it's all about a lot about support and resistance, and price, does not have the ability to break through a support level, or sometimes we have to be at least cautious with that. Eventually, support and resistance, some levels break, of course, otherwise price will always be stuck between two levels. But when it especially approaches the first time, and sometimes even the second time, there could be big struggles with that break, and it sometimes might not happen. Certainly not always. As we can see here, when price approached the bottom, it didn't break that bottom and went to the upside instead. So anyone shorting right at that level would be quite annoyed because seeing price move against themselves pretty fast. So anyone who would take into account that a bigger support level is around the corner, it's close by, is right in front of it, might want to filter that particular one out. The fourth step is the trigger. Now, the trigger, what I consider the first three steps, the trend, by the way, the opportunity, and the filters, is like my watch list, right? So if a trend is going and the opportunity is aligned with the trend and there's nothing blocking the trade, then I have it on my watch list so I can keep an eye on it. Now, what's the difference between a potential trade setup and a phase that we're really getting closer to trading? Let's say the difference between a potential trade setup and a trade setup. That is the trigger. And a trigger is something that is on the chart, and a trader can say, I'm not going to do anything with this pair or instrument until price gets here or here. What it does basically is makes our lives easier, because if we rule out any decisions until price does something up to or gets to or arrives at, or then we of course have a more calm peace of mind, state of mind, because we don't have any pressure, internal pressure, to say, okay, I have to make a decision now, I have to do something now. No, I'm not doing anything until it gets there. That's the advantage. That's the advantage of a trigger. Trend lines are trigger. Fibonacci's are trigger. Right? If price gets back to the Fibonacci retracement, I will consider going long or short, for instance. That takes mental pressure away from taking a decision now. Because if you want to take a decision, if you look at the charts without this plan, basically a trader could be tempted to trade at any point, and that pressure of maybe having to take a trade could eventually lead to suboptimal decisions that are not really aligned with the trader's trading plan. The trigger, what kind of trigger are we looking for here in this strategy? I'm looking for price to break through this parabolic. So now the parabolic is coming into play. either levels 2 or 5. That doesn't matter. It doesn't have to be both. It could be only one. It could be both, but it doesn't have to be. One or both. Either 2 or 5 doesn't matter. And the reason for is that basically there's a higher chance. Why I use 2 is that there's a higher chance that a breakout could occur. I noticed that if I only use the fast one or only the slow one, that the number of opportunities that occur are a bit on the lower side, and this puts it more in balance. So basically, what is the idea of that? Let's take a look at this screenshot here. Euro odd 4-hour chart. Now, you can see that where price, you see these orange circles basically. All of these orange circles indicate a moment where price is pushing through parabolics. Okay? Sometimes not maybe that visible because I have a big circle around it, but all of them do push through parabolics. All of these circles, or no, the four left circles also have the Tenkin aligned with the trend. So in this downtrend example, obviously because the Tenkin in most of this chart is below the Q, the blue, the Tenkin also has an angle to the downside within that downtrend. So those things are good to go. And then step 4, price is breaking through the parabolic. And that is the trigger. Okay, assuming that there are no filters to get rid of this or to filter out this trade, which is step 3. So once again, step 1, what is the trend? Down. Tenkin is below the Kyun. The red is below blue. Step 2, opportunity. Yes, Tenkin is aligned to the downside in 4 of the 5 here cases. Step 3, filters. Let's assume no for the moment. Step 4, trigger. Yeah, that's the break through the parabolic, which happens in those cases with those circle. Now, there's one other thing that I'm looking for that I haven't mentioned yet, and that is a close of the candle near the extreme. Why do I say extreme? Because in an uptrend, we're looking for a close near the high. In a downtrend, we're looking for a close near the low. If the close is far away from high or low, and there's a big wick, that means that there was not enough sufficient power for price to break through the level, and we see a kind of exhaustion, and that would be a filter for me as well. In a way, it's a filter. It's also, one could see it as a qualification of a trigger. Well, not too important the details here. I mean, how we call it, but the most important is that I do want to see a strong candle when price breaks out and pushes through either of the parabolics. In the most right example here, at the bottom, right lower bottom there, we see also a breakout. Everything else is okay, but there's one thing that doesn't match up, and that is the fact that price is breaking with a wick at the bottom and actually closes bullish within the downtrend. So although price pushed through parabolic and everything else is in the downtrend, we have a bullish pin bar at that spot. A bullish pin bar is not the type of breakout candle that I am looking for and that would install confidence in that particular direction of trading. So that would be a filter. We'd skip that one, and from the price action that we have in front of us, that seems to be a wise decision because price did retrace higher. So that's an important thing to mention. I hope that's clear. So also, apologies if I maybe repeat some certain spots twice or 3 times, but I want to make sure everything is clear. So that is the reason I want a clear close near the higher low to signal that the break is sustainable and has a good chance of follow through. all of those four left examples did follow through. Doesn't mean, of course, that if we have a clear candle close, that there always will be a follow through. No, far from that. I don't want to make that suggestion. That's not true. But in my opinion, I I have seen better results with this. That could change. Maybe in the future it will not be that important. But as far as in my research, I've seen that particular phenomenon. That's why I included the candle close in that analysis. So the next step, the very last one, the fifth part, basically of that checklist, is the actual entry. Many traders actually start with the entry, and as you can see, there's in this strategy, and I do believe in any strategy, it would be good to use these steps to qualify whether there is indeed a good setup. Because I think, personally, I think that if anything, traders tend to react too fast, and instead of thinking through whether that particular setup matches their strategy indeed, or if it's more wishful thinking, I think that in general this process is good for every strategy. I like to build my strategies with these steps, and I think it makes our a good mental balance, not to chase the market, to be forced to go through these steps so that one is really looking for alignment and not just trading something because it looks exciting or it seems interesting. That's what I think is a psychological benefit of that. And just making sure that everything is aligned. It's just like a double check, is everything indeed what I want to see? Or did I assume something which was incorrect? This checklist will help. In any case, of course, finally after this process, eventually at one point or another, there is going to be that entry. That is step 5. And the entry, I want a clear candle close near the extreme. I already talked about that part. And in that case, if it works, a market order or an entry order right there upon the candle close is the strategy idea. Now, it's not to say that one could not wait for a bit of retracement before taking the trade. There are disadvantages and advantages of that. Waiting for retracement means a better price of entry, but also means that the trade could be missed sometimes. If we look at example 1 on the left, a retracement indeed happened before downside continuation. Example number 2, we had an immediate follow through. Example number 3, we had a retracement. Example number 4, we had a retracement. So in this small example, small sample, 3 out of 4 got retraced. To keep things simple, I used the candle close as a direct entry order there, but it doesn't have to be. So that would be the entry method right there regarding this downtrend. So yeah, it's that simple. I hope it's clear, but it's just basically looking for a candle close near the higher low and then taking that. I mean, if you want to make it a bit more precise, or if you feel more comfortable with certain concepts and you feel that you can get better entry after your analysis, that's fine. Of course, I mean that's okay. But I mean the strategy rules that I set up for myself, wanted to make them a bit easier, so that they're very straightforward and less manual work is needed. So the trade management. Now, this depends, of course, if you're using the spot market or the binary options. As you know, want to discuss both. The trade management when using the spot market here is trail stop loss of the parabolic 5 or when the Tenkin recrosses over the Kyu. Now, what do I mean with that? The Tenkin is straightforward, right? The parabolic is straightforward. When the price hits the slower parabolic, the trade is exited upon the close. Unless there's a super beautiful candlestick pattern that's indicating continuation. A bit of an exception there. The other exit potential option is when If you're in a downtrend, the Tenkin recrosses back to the upside and price closes above the Tenkin in the downtrend example. In an uptrend example, Tenkin crosses below the Kijun again and price closes below the Tenkin. So that might be a bit complicated, but what it basically means, it's quite straightforward. Don't get confused. It's just basically looking for the Tenkin to go back to the opposite side. So if we're in a downtrend, the Tenkin is below the blue one, right? So if the Tenkin goes back above the blue one, we switch trends, right? So that's basically the trade management. As soon as we switch trends, that's when I want to exit. But there's one more requirement besides that, is that I do want to see price, not only do I want to see the crosses of these Tenkin and Kijun to the opposite side, but I want to see price close in a downtrend. I want to see price close above the Tenkin. I want to see it close to the opposite side. In a downtrend, I want to see price. Sorry, in an uptrend, I want to see price close below the Tenkin. It's always the opposite. Okay, so in both the candle close and the Tenkin Kijun cross. All right. The results I had with these are basically the cross gets a better return. What I've seen with the Euro odd. The parabolic has the advantage that there is less, let's say, less drawdown, because if the currency doesn't go our way, then the parabolic will exit earlier. With using binary options, one can use, of course, has to use, of course, the time factor here, and in that case, using well, a number of candles, I think is the best. In my research, using 5 to 8 is a pretty decent number, because if you, for instance, have this breakout candle here, let's take a look at the first example. 1, 2, 3, 4, 5, 6. It's the eighth candle that really moves our way. In the second example, 1, 2, well, it actually moves our way immediately. In the third example, so it doesn't matter. 1, 2, 3, 4, 5, 6, 7, 8th / 9th that goes our way. Fourth example, 1, 2, 3, 4, 5, 6th that goes our way. 7th. So yeah, typically, as you can see here, yeah, 5 to 10. So, well, what does that mean? Everything after 10 is a reasonably safe number, maybe between 10 and 15 of those 4-hour candles. Now, what are the parameters I use for that strategy? I use it on the 4-hour chart, although who knows, maybe it works fantastically well on the hourly and daily as well. I don't know, but I've developed it for the 4-hour test, 4-hour chart. Excuse me. I'm not aware. I didn't look at other time frames, but it could be maybe very well on those as well. So if you know, let me know. Would love to know about that. I have tested it and used it on the Eurod, and that is my primary currency pair. But I think it's also, by the way, good for yen pairs and big moving pairs. All right. So it's probably could be usable for all currency pairs to a certain extent. I mean, not the very, very rare ones, something that's decently traded. I think at least, but that's something that could be still worth to check, of course. All right, but the bigger moving pairs are better for that. Now, first of all, before I maybe continue, is I hope that part is clear. If you might want to already maybe write some questions down if you have those regarding the strategy. Is it clear? Does it make sense? The main bulk of the strategy I've now explained. So this could be a good moment for you to ask some questions, or let me know if everything is clear. Now, there are some optimizations one could use. An AO is one of those. All right, what is the AO? The AO is an awesome oscillator. It's a indicator at the bottom of the chart, and it indicates basically the strength, the momentum as well. Here it is at the bottom of the chart, and it indicates where price is trending to, because if the AO is below the middle line, it's in a downtrend. If the AO is above the zero line, it's an uptrend. And also has an idea about basically the retracements. If you have a strong AO downside, right, then you are looking for retracement back to the zero line for follow through to the downside. So the AO is a useful tool. All right, if you have the trend often enough, you see a strong AO. Like here, for instance, you see the downside AO very strong. Price just barely makes it above the zero line. So downtrend, and when it gets back to the zero line, that's the opportunity. That's the AO retracement. And when it gets back to the zero line, it's of course completed. The retracement is completed. The AO could be a very useful addition to this strategy because it gives an idea when you can get a follow through of the trend. For instance, in this downside, we see the AO nicely moving down, but then when it reaches the zero line and starts to go back in a retracement, that might be a good moment to wait for another follow through. Here we see, for instance, in general, the AO very strong, and if we get back to the zero line, that's always a moment where we could see some follow through eventually. Be aware though that the price could make a bigger consolidation prior to a bigger fall again, like it had here, for instance. So the AO could give you some extra value with analyzing the trade. Let's see. We have a question. Where do you place the stop losses? Yeah, if you're trading spot Forex, I put the stop loss, excuse me. I put the stop loss. I was looking. I indeed forgot to mention it. Sorry about that. I put the stop loss at the top of the candle. The top, not the candle. The top of the top, basically, the most recent top or bottom. The downtrend top, uptrend bottom. So if you look at the left orange circle here, I would put the stop loss above this high here. The next circle, I would go above this high. This circle, I would go above the same high because there is no other high that is closer to that. With this circle, I would go above this high. And why do I put the stop losses there? Because all of these candles, these tops, have one thing in common. They have two candles to the left and two candles to the right, where the candle in that middle is higher than the two candles to the left and two candles to the right at minimum. There could be more though. That's the definition of a top or bottom. When there are two candles to the left, two candles to the right. So when a candle low is lower than the candles around it, that's a bottom. If the candle high is higher than the candles around it, once again, two left, two right, then that's the top. I would use those tops and bottoms for stop loss placement. I would be pretty curious to see how a stop loss would be used with the candle high, but I'm scared that the candle high could be relatively tight stop loss. However, in this example, it didn't do too bad, but I always use the tops and bottoms. The stop losses are a bit wider because of that, but trade is technically safer. I don't aim for a reward to risk ratio though. Obviously, at the end of the day, I do have, I get a reward to risk ratio out of it, hopefully, or at least, I mean, there is a result at the end of the day, but I don't aim for something. I have a trail stop that I use. Now, this could be always changed. I mean, if you don't like the trail stop loss, try testing something else. Try testing TPs indeed, 2-to-1, 3-to-1 ratio maybe. But I use a trail stop loss and don't have any TPs in mind. So I'm using trail stop loss of parabolic, and the trail stop loss of the Tenkin recross. All right, so what varies from pair to pair what the results are, what the actual reward to risk ratio ends up being. I mean, let me see if I can find some quick results here. My PC. Just give me a second. But obviously the reward to risk real life is different than the one we were aiming for. Um, so I don't have anything I aim here for. I just used it to trail stop loss. The advantage of that is that the tank can sometimes, if it really goes for a good run, before it recrosses over the Q, and it could really go for sometimes big winners sometimes. Let's see. I have here years of data, 1 year of data here on the Urad. Quickly, I see uh, five, more than 5-1, which is a lot. That's reward to risk 5-1. That's on average. That's on the high side, right? Not every pair is going to have that, obviously. The Urad is a big mover though. The 5-1 is with the Tankendo. So the AO is just an extra, basically, to have an idea when price is ready again for a trend continuation. The fractal could always be used. Fractals are those bottoms and tops, basically, right? Because the fractal is an easy way to see tops and bottoms because it will automatically plot that particular level on the charts if you use the fractal. Well, if you have questions, let me know. In the meantime, please be aware that we discuss on Monday mornings, actually, we look at the Forex market. All right, that's well, it's not new, but it's a live market commentary because we've been doing it already for a while. But there's no charge, obviously, for you. It's free for you to join. We take a look at all kind of stuff regarding technical analysis, price action, candles, fibs, trend lines, primarily moving averages. We take a look in about 20 to 30 minutes at what could be expected this week. We take a look at the majors: Euro dollar, pound dollar, IUSD, dollar yen, and XAU USD. The session is live on Monday mornings, 8 a.m. UK time, always every week, 8 a.m. UK time, unless I have a holiday. But let's say in 90% of the cases there, or 95% of the cases, there's a Monday at 8 a.m. UK time. There's a session where we take 20 to 30 minutes live look at the charts. And if you can't join the live session, we have a recording that is available then, which could be viewed a few hours later. That recording will be sent to you via email if you register with your name and email. That's the only thing that's needed at blog.binary.com/weekly trading room. blog.binary.com/weekly trading room. And that's basically where you could register, and you can get a recording done and look anytime you want. Let's see, I got another question. What is your win-loss ratio with this system? So when looking at the same data that I mentioned on the reward to risk ratio there, it was 50-50, in fact. So 50-50 might not seem very attractive, but it is if you consider the reward to risk ratio, right? Obviously, if you only get 1 unit of reward versus 1 risk, well, then there's nothing to gain. But with 5, those things change. Now, as always, of course, past results do not guarantee anything in the future. I should add right away, although we had the risk disclaimer at the beginning, still, those things happen. Strategies change. parameters change, but that's something to consider, of course. But yeah, definitely what what I've seen so far from this strategy is it's interesting. It has good breakouts. Capitalize. What I like about this strategy is the fact that it capitalizes. It's a simple. I think personally, I think it's a simple, but I understand that it depends on your affinity with Tenkin. But it's a straightforward way of looking at charts pretty fast. One can get at looking at it when you get more experience in the hang of it. And I think that when the Tenkin and the Q really start to trend and price then pushes through the parabolic, it's just a neat way of looking for breakouts. Well, if you have any preference, of course, let us know with regard to the webinar next time. Otherwise, I think there's already one planned for next month. In fact, on let me get the date, the 19th of August, Tuesday. It's exactly 4 weeks from now. And we'll be looking at exits and, yeah, exits basically. Trade exits as far as I remember. So, hope to see you then. Uh, please register and looking forward to see you in August, right? And 19th, yes, 19th of August. Oh, I meant to say the 19th, but maybe I said the 9th instead, but that was a mistake from my side. Yeah, Tuesday the 19th, 1-9 indeed. Oops. And that's 4 weeks from now on Tuesday again. Well, folks, I don't see any questions, so I do thank you for spending your time with me, and I hope you do find this value. Maybe you can always take a look at testing yourself, of course. Try it, demo it, test it yourself. That's always important with anything that one learns. Even if it's a small part, even if it's multiple parts, even if it's just a segment of it, hopefully, I do hope though that you've picked up something that is useful and interesting for you for your future trading. With that said, I wish everyone a great evening and a great week, and see you soon. Cheers.